My name is Greer Smith, and I'm pleased to be your host for our Intrepid Capital webinar. Our goal with this new quarterly series is simple. We want to share our perspectives on credit markets and dig into questions we hear most often from our investors and our partners. Today, we're joined by members of the investment team, Joe Van Cavage and Matt Parker, and our Chief Investment Officer, Hunter Hayes. With that, I'd like to hand it over to Hunter to set the stage with some opening remarks for us.
Thanks, Greer, and thanks to everyone for joining us. It's a fascinating time in high yield. Spreads continue to hover near historically tight levels, yet the absolute yield available to investors remains, perhaps surprisingly, quite compelling. I've been describing our outlook as reluctantly optimistic, and that still feels right. We see plenty of reasons for caution, whether it's the steady drumbeat of corporate blowups, the uncertain trajectory of rates, or the broader macro jitters that seem to shift by the week. But those same cross currents are what create opportunity for investors who stay disciplined. In a market where there's a lot of glitter, but not much gold, we think there's still real value for credit pickers who do the work, who underwrite carefully, think independently, and don't confuse yield and value. At Intrepid, we build our process around that idea, staying bottom up, selective, and focused on preserving optionality. The next few years may present some incredible opportunities, and we're excited about how we're positioned for that.
Thanks, Hunter. I'd like to expand on that and open things up a little bit. Any broad thoughts from the team on the current state of the credit markets? Spreads are pretty tight, as we all know. How are you finding value in high yield right now? It seems like the market might be pretty picked over. Anybody have any thoughts?
Thanks. Great question, and I'm happy to address it. We would agree with the premise of that question that things are picked over, very picked over. As you mentioned, spreads are tight on a historical basis, however you want to look at them. And as you might expect in reaction, to this development, we have been kind of gradually de-risking, the strategy into this rally since kind of the tariff tantrum in April. Should this trend continue, spreads continue to tighten, risk continue to be priced, maybe not as attractively as it should be, you can expect us to continue to kind of gradually move the needle lower on credit risk in the strategy. All that being said, our job is to carefully weed through this market that exists and find the interesting inefficiencies in it. We focus on what we think is an extremely attractive universe of small tranche, off the run, short duration, misrated or unrated kind of niche corporate credit. So knock on wood, we continue to find opportunities to put money to work at what we think are attractive yields for the risk, the credit risks that we're taking. Yeah, however, it is harder today than it was 3 months ago, 6 months ago. Given how tight spreads are, that makes sense. So we are being a lot more careful. But this is a fruitful niche. We think it's an evergreen niche, and we are working hard to find opportunities within it. And so far, we feel like we're successfully doing so.
Awesome, Joe. It sounds like you're always looking for exciting opportunities. Historically, you guys have rotated across a range of different income opportunities. Converts, leverage loans, bonds. Which of those or any other pockets you think are offering the best value today? What are you avoiding? What's different today than it has been in the past? So I'll kind of open that up to the floor.
And similar for those buckets that you mentioned, Greer, the leverage loans, busted converts, conventional high yield bonds, that allocation has been like very consistent actually over the last few quarters. Now, of course, beneath the surface, there's been plenty of turnover in individual names and then some movement in our sector positioning as well. But as I think about, have there been any kind of patterns or themes underlying those changes in sectors and positions? From a top down, there really hasn't been what I would call like an intentional decision to add to a certain sector or reduce exposure to certain sectors because we see some broad risk out there. It's been much more kind of bottoms up, case by case analysis. And, we're really just trying to underwrite idiosyncratic opportunities. If anything, I guess maybe to get specific for a minute, we've perhaps upped our exposure into names where you probably heard us talk about before, trying to underwrite resilient businesses. We've sometimes informally called them like our beer, shoes, and underwear type businesses. Just as a few examples that come to mind, on the shoes theme, Skechers is a large position for us. They sell affordable shoes, have performed well historically through cycles. Companies like food distribution businesses, tobacco companies that are very recession resistant, and even some companies that are, historically kind of acyclical, or excuse me, countercyclical. So, like a pawn shop, for instance, debt collectors. So I think, as we think about de-risking, as Joe mentioned, if anything, in the last few months, we've been looking to kind of increase exposure to those types of companies.
You know, these different pockets Greer mentioned of value that we've historically traversed between converts, levered loans, conventional bonds. That is a big differentiator for us. We've noticed over time that there are not many other income strategies that sort of move seamlessly across these different pockets of value. So when we do see compelling opportunities, whether, it's in busted converts, for instance, like back in 2020 when COVID first hit, stocks traded down quite a bit initially, and we found some really good investment grade like opportunities in busted converts, or 2022 when rates started to go up and levered loans started to look more interesting. We took an outsized weight there. We can be nimble and take advantage of those mispricing opportunities. Today we're not really seeing anything that jumps off the page at us, at least by bucket thematically across those different verticals. But we're always looking out for it, and we will be nimble when we see it.
Awesome, awesome guys. Let me ask you another question, kind of a follow-up there on looking for value. Recession is a big word these days. A lot of folks are throwing around. What are the risks and catalysts do you think that could tip things over?
I I'll start. I wish we knew, right? If we knew what it was, we'd definitely do our best to avoid it. History offers some clues. There are a lot of things to be nervous about today. We're not denying that. And so, excessive leverage in the system, consumer health, geopolitical risk. You could pick up a newspaper any morning of the week and see plenty of headlines that I think would give you pause. We're certainly tuned into all those and aware of all of them. That being said, that's one side of the equation. The other side of the equation is how well can companies handle the shock of something like these events? And from a balance sheet perspective, you know, how buttressed are they? How protected are they from some sort of decline in revenues, some sort of hit to margins, or some combination of bad things? In our view, and you'll hear us reiterate it probably a few times on this call, we think that the high yield space and liquid credit generally is pretty healthy today. If you take a historical look across the asset class, there aren't many other times in the history of high yield, for instance, where things have looked this healthy. There's a lot of things you can point to for that. I think that the fact that most of these companies, or a lot of these companies, are still benefiting from lower fixed rates from debt they underwrote back in the zero interest rate policy period helps. I think it helps that private credit has started to take out some of the lower quality companies from the index. So there are some reasons to expect this. Um, and so even though we're certainly nervous and aware of all these recession risks that exist out there, and have, the humility to admit we don't know which of them is necessarily going to tip us over into the long-awaited recession everyone's been talking about for years, we do think, specifically with our portfolio companies, there's certainly a range of options that they have to deal with whatever does happen, liquidity, levers they can pull, et cetera. And so we feel good about the way that we're positioned relative to those risks. But I wish I could point to the one that is going to be the catalyst here. The reality is no one knows.
Yeah, and I'll maybe just for the fun of it throw out one theory of something that could end this expansion, and maybe more of a personal opinion than kind of a house view, but I think one could be just the AI investment cycle. When I think about how a typical business cycle ends, it's often because there's excess leverage or excess investment, and I think the latter would potentially explain, what could cause the AI, hype to potentially reverse. When we look at some of these headlines on the AI investment and CapEx spending, I mean, some of the numbers are just so unbelievably huge these days that when we, for example, I think it's, we're spending hundreds of billions of dollars annually in data center spending. I think OpenAI alone has committed to, $1 trillion over a few years in CapEx build out. So when we do the math and try and reverse engineer the amount of revenue, margins, and profit that's required to earn even a reasonable rate of return on that investment, the assumptions you need to make start to look pretty egregious to us. So we think that's, potentially, if that starts to reverse and you see VC funding dry up, you see AI story stocks go down, and the kind of AI economy's contribution to GDP flips the other way, we think that's, one potential thing that could sort of end this expansion. Not too dissimilar from what you saw in 2000 when the tech bubble crashed, right? And actually, one thing I think that's kind of interesting, if you go back to that analog, is if you look at the market carnage that took place there, from March of 2000 through the end of 2003, the NASDAQ, where a lot of this risk was kind of isolated within with tech stocks, the NASDAQ was obliterated, right? But the Russell 2000 small cap stock index was flattish over that period. High yield bonds were up mid-single digits. The ag was up high single digits. So, we think if you see something like that play out this time, we don't think that necessarily creates kind of a systemic credit event and a washout in fixed income.
I want to shift gears just a little bit here, guys. Recently, Tricolor and First Brands have been in the headlines. What do you guys think? Are those isolated cases? Is this a sign of broader market distress? What can you tell us? What does this tell us about private credit versus public markets?
Yeah, I can take a first stab at that very loaded question and a good one. Thanks, Greer. So just so everyone listening is aware, because my wife accuses me of thinking that the world revolves around credit markets, and maybe not everybody is up to date on the Tricolor First Brands news, but these are a couple of larger blowups that have started to play out over the last couple months in credit markets. And I think it's been easy for the media to sort of cherry pick these two and turn it into whatever they want, private versus public credit, the state of underwriting, the start of the next recession. I mean, we've seen every headline try and, use this as its rally cry for whatever purpose. Our view, I think, is that it's hard to draw summary judgment from these two cases. In both instances, the risks and the I guess catalysts for the demise of these two companies seem pretty isolated and idiosyncratic. I suppose it could be a sign of a little bit lazier underwriting. Certainly a lot of smart people in both structures. So I don't think even that you can draw a summary conclusion from. What I will say is a lot of money has flowed into credit over the last few years, and that money has had to find a home. So there's no doubt in my mind that there are other issues out there, other problem children that may be the headlines of tomorrow. I don't think we've seen the last of higher profile blowups, in the near future. But is it systemic? Is it a sign that the entire credit space has forgotten how to underwrite and that everyone's gotten lazy? Is it a sign that public credit or private credit are better underwriters? I don't think you can draw conclusions from these two cases to say that, despite what the headlines might imply. So we follow these stories. We think they're interesting. We think it's important. And to the extent that, there continue to be more instances like this, we'll certainly stay abreast of those. But I think it's hard to draw any sort of summary conclusions from these two cases.
Yeah, and maybe just to add a little bit on the whole public versus private credit debate, which we're obviously asked about quite a bit. As Hunter mentions, obviously, it's just hard to generalize, right? And so much of it depends on the quality of the underwriter. And, on the private side, frankly, there's a lot of shops that have been doing this for a long time that we respect, that we think are disciplined underwriters that have the resources to kind of operate through the cycle. It's more of the others that would concern us. I think anytime you see a strategy or an asset class that has such a rapid increase in assets, that kind of gives us pause and suggests to us that, eventually you're going to hit a point where those returns get competed down, or the level of risk that's taken to earn those returns goes up. Kind of the classic reaching the point of too much money chasing too few deals, right? So, broad strokes, it's hard for us to draw too many kind of conclusions one way or the other on private versus public credit. What I would say in favor of public credit is, we think there's more transparency, right? If you pull down the top positions of any public credit fund, you guys can go pull up their financials, make your own assessments on the credit risk that exists there. And then, perhaps even more importantly, just the existence of a liquid trading market, I think in a lot of cases lends a little bit more credibility to the marks. So just a few other points to highlight on that topic.
Yeah, and I will kind of close out Matt's last point with a couple quick ones. Just speaking to the public, to the benefit of the public credit market, the high yield market is the highest mix of double B rated paper ever, which is the highest kind of strata of high yield ratings. The secured mix versus unsecured mix is the highest it's ever been. So these are kind of pretty positive proof points to the argument that a lot of people are making, that the high yield market is not what it was in the 1980s, that it's a much higher quality index today, and that it should lose this kind of junk bond association. We are always skeptical of any time, you're kind of making an argument or you hear an argument that this time is different. But yeah, I mean, it's hard to deny those proof points. And I would also add that in terms of kind of testing these proof points, it was a short time period, but the tariff tantrum in April, the high yield market was down 3 or 4% from peak to trough, which, no one wants to be down, but I mean, the stock market was down, depending on which index you look at, 20% or more. So, that's a different relationship than the past. Now we are focused on these inefficient niches that we talk about constantly, and not the broad high yield market. I won't say we keep our thumb on the pulse of these stats, but we would argue people like looking at the private credit and the public credit market, like there are real reasons not to approach the public credit high yield market with as much fear as you might in the past.
I think that's a really good and concise answer that kind of sums it all up there, Joe. Hunter, why don't you bring us home?
Yeah, thanks, Greer. And thanks everyone for listening. If there's one lesson that we learn with markets over and over again, it's that you should stay humble. None of us know what that next catalyst is going to be, as we've mentioned on this call. But we do know that cycles exist and that we need to be prepared for when things swing the other way. That's sort of the core mantra with how we approach credit here. So, I often think of Charlie Munger's line, all I want to know is where I'm going to die, and I'll never go there. We don't claim to know where we're going to die, when we're going to die, using that as a metaphor for when the next bear market might rear its head. But our job is to be prepared, to build in a margin of safety with how we're underwriting things, to find companies that can be resilient in those times of distress. We feel pretty good about, the companies that we've underwritten today, and their ability to weather the storm. So we appreciate everybody for tuning in. We appreciate your trust in us, and we're available to discuss this further at any time. Thanks, Greer.
Yeah, thank you again, everybody, for joining us today. We hope you found this discussion, helpful and enlightening. We look forward to seeing you at the next one. And if you have any topics that you would like the guys to talk about, please shoot us a line, and we will be sure to mention them next time. Thanks again.